stock tattooed chef. So we're going to look at their 10Q. This was released in the middle of August. And so we're just going to look at some of their statements, like their balance sheet. So you can see they have 140 million of cash, which is pretty impressive. Their accounts receivable is 23 million. So that's what other companies owe them. And their inventory, how much products they have ready to be sold, presumably, although we'll see that broken up a little bit more, but their inventory is 50 million. So quite a lot of assets that they currently have. And so we're talking about close to $250 million, and that's up 10% from the previous 6 months, which is pretty good growth, right? If every 6 months they're growing by 10%, that would be great. Obviously, everyone wants it to be bigger, but that already to me is pretty impressive. Now you can see that goodwill did not exist 6 months ago, but now it does. So they obviously acquired some companies, and they overspent by $20 million, at least according to the accountants. And we'll talk about that a little bit more. They also had a deferred tax asset of $43.5 million, and now that's gone, right? So that went to paying off taxes. Okay, in terms of their current liabilities, it's gone up by 50%. That to me is not such a big deal. They are growing, right? And so some of this, major amounts of this are, how much they owe to some of their suppliers, right? Their accounts payable, whoever that is, they're paying, whether that's shipping or whatever it might be, their accrued expenses, those types of things, their line of credit, that you'd expect those things to grow as the company grows. So that doesn't bother me. I think that's actually positive, in my opinion. In terms of their revenue, this is amazing, right? They went from pretty much 70 million to 100 million. That is great. That's like a 50% increase in terms of the revenue. If I were an investor, I'd be so excited right now. Now, what's the big problem? The big problem is their gross profit has hardly moved. It went from like 13 million to 13.8 million. And so you'd expect a 50% increase in revenue to move much more gross profit than that. But of course, they had a major problem. Cost of goods sold went up substantially. So as much as the revenue went up, the cost of the goods that were sold went up just as much. So let's say they need carrots. Carrots went up an enormous amount in price. Now, why is that? That is going to be a key question, and we'll talk about that a little bit later. But that, to me, is a red flag. Now, red flag does not mean that I would not invest in this company. Red flag simply means I would want to know the answer to that question. Is this temporary, right? Economies of scale usually mean the more you produce, the more you buy, the cheaper things get in the aggregate. Meaning, a carrot, maybe you spend more on carrots as a total, but each carrot might only cost, 50 cents instead of 65 cents. And so why is the cost of goods sold going up so much? Almost linearly, it's going up as much as the revenue goes up. And so that would be a big question. Obviously, cost of goods has gone up. And I did see somewhere about the CEO saying it's temporary. Well, why is it temporary? This is not broken down for me. And that really bothers me why it wasn't broken down, because it's obviously something very important. And I would love to know, is this just raw materials? Is this paying workers? Is this because something happened at one of their plants? Why is this temporary? Their operating expenses went up about 6 times. This is also something that I would love to know. Why? What's going on here? Now, this one, luckily, is broken down a little bit later. And that's what I'm talking about. I need more information to understand what's going on with this company. And sadly, with so few 10Ks, 10Qs, it's hard to work out the financials exactly. Now, in terms of their income tax expense, huge income tax expense, right? Went from 1 million to 44.5 million. Why is that? And is that temporary? That would also be somewhat of a red flag that we would need to have an answer to, especially when they have such low gross profit, right? Why are they paying so much in income tax? What's going on here? Now, they obviously have a net loss income of 61 million, and a major component of that is income tax, but the loss of income from just operations is already, if you look up there in the table, it's already 15 million. And so, what exactly is going on with this company that they're generating so much revenue, and the previous 6 months, or the previous year, I should say, their 6 months in terms of income from operations was positive. So what kind of happened? What? Well, it's the operating expenses. So why, right? We would want to know the answer to that. That's similarly another red flag. Why is this company being so negative in terms of their income? Now, if we look at their cash flow, similar story, positive 7 million, now negative 61 million. And obviously a major portion of that is going to be the fact that they used up their deferred tax asset. So maybe this is not actually really affecting their cash balance because they really just used up an asset, or they prepaid their taxes, or they had losses from certain years that they used that to mitigate what they owed on taxes. So maybe they didn't really lose 61 million, but they did technically lose that deferred tax asset. So, they've lost that. But I guess if you have a deferred tax asset, you got to use it eventually, or presumably you might lose it, or, you just never use it. It doesn't make sense to just have it on the books forever. So I'm not saying that that's bad, but they no longer have it available. So that's something to consider. And why is that something to consider? Well, if they continue to have to pay taxes at this rate, right, the next time, they really will have a negative and a major loss of income. So that's something to consider. Why are they paying so much in taxes? By the way, not an expert on any of this. If you are, please leave a comment below. And of course, subscribe. And this is for entertainment purposes only. Now, in terms of their inventory going up, I think that's good, right? That's their biggest change in operating assets and liabilities. And that's something that just is going to happen as you grow your company. So that to me makes a lot of sense that it went to the negative 24 million at the end of the day based off of everything that happened here. Fine. And so we're going to have to kind of explore what was that 24 million difference. Where did that come from? Now, in terms of cash flow from investing activities, this also makes a lot of sense, right? They invested $10 million into property, plant, and equipment that they already have. That makes a lot of sense. And maybe that'll improve their cost of goods sold because that'll reduce their costs because they've made things more efficient. So there's some positivity there. Now, they had 34 million, I suppose, in terms of acquiring other companies. And we already saw that their goodwill was 20 million. So they've overpaid, right? Really, they should have paid, let's say, 13 million, 14 million, 15 million maybe for these companies, and yet they overpaid by 20 million. Not great, but I'm going to give them a little bit of a break on that. Why? Because this is a growing company. They may not have the time to find the right companies, and if they find one, they can't just take the year, 2-3 years to build up what that other company has. It would just be much more efficient and more saving in terms of money, capital, and time to just overpay and get that immediately and get that deal done once they find someone they like. And so I'm not actually going to say it's so bad, but it's something to consider. Now, luckily, they're not buying a brand name company that really overcharges. They're just buying some manufacturers at, presumably pretty cheap prices. And if they were having the gross profit they should have, this would not be so alarming. Sadly, they didn't really have gross profit in the amount that they really should. And so this is a pretty big ding, I suppose, in terms of what they're making. Now, at the end of the day, they still have $140 million of cash, so they can do these types of purchases, and it doesn't really bother me. Now, in terms of their cash flow from financing, this is pretty interesting. Their exercise of warrants, they got 74 million people converted their options, or their warrants, I should say, into actually owning the stock, and so they had to pay a certain amount to the company to exercise those, and that the company got 74 million, which is great. And so they're up based off of all of this, the negative of the 60 million cash flow, I suppose, and the proceeds from the exercise of warrants. And if you factor everything in, it works out to be that they're up 8 million. And so at the end of the day, they, only had to actually pay in terms of cash 250 grand. That's what it looks like here because of their deferred tax asset, helping them out on that. And so the cash at the end of the period, 140 million. So pretty positive information. There are some, let's say, red flags in terms of I want to know the answers to some of these questions, but the company is obviously growing. Now, they got bailed out a little bit by these warrants. So, but nevertheless, it's not like great positive news, but at the same time, they might have known all of this was happening. And so they made, the acquisitions that they made. And it's very likely that maybe, and I'm not knowledgeable on income tax, but it's very possible that major amounts of their income tax are specifically because they got such a huge amount of money from people exercising their warrants that's really what they're paying the income tax on. And so that's not something that's going to routinely happening, presumably. Now, why do I say that? Well, because you don't want to dilute. And the CEO himself said they mitigated the dilution of these warrants to 15.3 million shares instead of what would have been the full amount of 20 million shares. And so obviously he doesn't want dilution, and he understands people don't want dilution, but there was still dilution. And so you have to be a little bit nervous going in the future. Is this what they're going to do to cover their growth and to cover their ability to acquire companies, right? That's not what you want to see. You don't want to see this type of trend continuing where they're taking money from investors, diluting them, and making these acquisitions, unless they're really positive acquisitions. And I'm not saying these are negative, but you don't want to see this keep happening again and again and again unless they're really, converting those acquisitions into money. But if they are, well, why do they have to keep doing it? So something to keep an eye on. I don't assume it's going to keep going. I'm not so worried about that. But if it does keep going, maybe that would start making me nervous about the management of the company. Now, in terms of sales and marketing, you can see that they went up a substantial amount. They're really focusing on this, putting about almost 12 million from the 2 million. So really a huge increase in terms of sales and marketing and promotions, things like that. So that's pretty interesting, something to keep an eye on. Not bad. I think sometimes you have to spend money to make money, but something to consider. Is this going to keep increasing? Is this going to stay where it is? How do you feel about that? And we'll talk a little bit more in one of the notes that breaks this down a little bit more. So not a big deal, but this is going to be a major part of those operating expenses, right? It went up to 24 million. Well, now you can see half of that is from sales and marketing. Okay, now in terms of their revenue, comes from 3 customers, a big chunk. And customer C went down from 38 to 30% almost. This one went down a percentage, customer B, and customer A went up 2 percentage points. Now, why is this important? Well, why this is important is a very key thing. Now, sadly, you don't have the numbers here. You only have the percentages, and so this can be confusing. It almost looks like, well, some customers are going down, one customer went up a little bit. But the truth of the matter is, because we know their revenue went up substantially, right? There was a 50% increase in revenue. What that tells me is likely it's very possible that all 3 customers have actually increased their buying of Tattooed Chef. However, there might be so many other customers in the mix now that the percentage of the revenue is much smaller from these 3 customers, right? So what used to be 86% is now 78%, but that might be simply and only because there's more customers, and that is really good news. And so that's why I'd love to see the actual values here instead of just percentages, because I don't know what's happening. Are some customers turning off of Tattooed Chef? That could happen, and just the other customers, even though they're much smaller, they don't make up 10%, so they're not going to be listed. But those other customers, well, maybe they're making up the new bulk of picking up what these customers are leaving off and buying even more. I don't think so. My guess is that these customers are actually keeping the same amount or even increasing the amount of their purchases. Obviously, customer A increased their percentage, but because the revenue is increasing, because they're getting more customers, which I think is a good thing, they're diversifying the customer portfolio, they're relying less on these 3 customers, well, except for customer A, I suppose, but that is a good thing, because if one of the customers just all of a sudden cancels their orders, right, you don't want this company to just fall apart based off of that, and I don't think it will, but the further it moves from relying on 3 major customers, the better I'd feel. Obviously, with big companies like Walmart and Target and Costco, Price Club, whatever you call it, that might not be possible. There's some major companies, some major stores, some major clients that they just might forever make up a major portion of sales, which is not great, but understandable. Now, in terms of their revenue, this I thought was fascinating, right? In terms of private label, they're increasing that, even though the percentage is going down, and this is why percentages really bother me, but they're increasing those sales of private label. So they're pretty much taking, let's say Kirkland says we want to create a food, or Walmart says we want to create a frozen vegan entree, do it for us. This is what we kind of want, and they'll just do it, and they'll sell it to Kirkland or whoever it is. And why this is really important, actually, and obviously I just want to mention that you can see Tattooed Chef specifically revenue stream is going up, but why private labeling is so important and so amazing for this company, and I think such a big positive that I've seen no one really talk about, is because their competitors are paying them. Their competitors are paying Tattooed Chef to make them products. And yes, maybe Tattooed Chef would make a lot more money if they sold their own product. I think that's obvious and probably true. Otherwise, why bother making Tattooed Chef? However, nevertheless, this is a good cushion, because when your competitor wins a little bit, when your competitor gets a bit of the market share, you're getting a bit of that market share too. And so there's a cushion there, and that's pretty impressive. It's almost like your competitors are paying you money, right? And so Tattooed Chef is competing with Walmart's or Target's or Costco's private label. Well, in a way they are, but on the other hand, they're making money from those private labels, at least some of them. I don't know how much. Now, those 3 customers who are buying Tattooed Chef products, right? We said that they were around 80% of the revenue. Well, here you can see that neither Tattooed Chef or private label makes up 80%. And so those 3 customers presumably are doing both. They are both buying Tattooed Chef products and private labeling. And so, like I said, these major customers are their competitors. So they're still buying Tattooed Chef, but once again, they're still going to be paying Tattooed Chef when their own and competitive product makes money, right? So this is a kind of win-win in a way of Tattooed Chef. Other companies don't necessarily have that going for them. They just have their own product. They don't make money when their competitors also make money. So this is a huge positive for this company, almost like a moat, if you will, right? If they control as much of the frozen vegan entree sector, the more that they can control, especially even with private labeling, it almost makes this moat. It almost makes this ability for people to have a hard time competing with Tattooed Chef. And so I think that's a great thing. Is it the greatest moat? No. Is it flawless? No. But it's a cushion. It's something positive. Okay, now in terms of accounts receivable, and this is why I don't like percentages. You can see customer B, their percentage went down, so they make up much less of the accounts receivable. And customer A went up, customer C went down substantially. Why is that? Is that because, like I said, all these other customers who are signing up with Tattooed Chef, do they have much bigger accounts receivable? Is that what's going on? Or did these customers just pay off their accounts receivable? Or the worst case scenario, do these customers no longer want to buy anything from Tattooed Chef? And so if that were the case, which I don't really believe, but they might pay off their accounts receivable, meaning the accounts receivable means Tattooed Chef is owed money by these customers by a certain percentage, and these companies might pay off those accounts receivable on a regular basis, and if they're not ordering as much, their accounts receivable might keep going down and down and down and down, right? So is that what's happening with customer B and C? Maybe. Or maybe there's so many other customers with accounts receivable, so it's really hard to tell what in the world is going on when you just look at percentages. So I don't like to give this too much analysis, but I just want to point out the issue just so you know, and you have a feeling when you look at percentages that they can really be misleading if someone's talking about them or you're looking at them. Okay, now I thought this was interesting. In terms of long-lived assets, you can see the totals doubled. So, especially if we're talking about property, plants, equipment, things like that. And so the United States, it's tripled, maybe even a little bit more. And Italy, it's almost doubled. So what that tells me, that this is a little bit of a red flag. A yellow flag? I don't know. But the way I understood the company is a lot of their raw materials come from Italy. A lot of the manufacturing is done in the United States. And so you can see in terms of their investment, what are they growing? They're obviously doubling in terms of their actual goods that they can make, right? Their raw materials, I should say. Now, is that doubling the capacity so they can do twice as much broccoli? Or is it diversifying into all these different, legumes, let's say, or whatever it might be, that they need to produce, and so they need totally separate farms or totally separate equipment? I don't know exactly what's going on. Like I said, there's not enough information, which really bothers me. But what's interesting is, as much as the actual ability to grow these raw materials, right, originally was much more. There was a lot more money in Italy versus United States 6 months ago. And now there's a lot more money in the United States. Why is that? That's like a little bit funny to me. You would think that kind of ratio might stay true. Well, that might be a little bit of a yellow flag because maybe as much as they're increasing the raw materials, they're becoming a little bit less efficient in terms of their manufacture because they're doing all these different SKUs, they're doing all these different products, and so they need tons of different machinery, tons of different plants, and so that might be contributing to the cost of goods sold, is pretty much what I'm getting at. Is that what's going on? Is that why they're being less efficient? They're not getting these economies of scale? I don't know. Makes me a little bit nervous, but that's something to keep in mind. On the other hand, it might be that they're being even more efficient, and now they can, with all these new plants and quadrupling of their plants, they'll be even more efficient with the raw materials, and things are going to go even better, right? This is one of my problems with not understanding some of the details of the company. That's what happens, I suppose, when you only have so much information. Okay, so in terms of their inventory going up, which, like I said before, makes sense, but now we see the breakdown. The raw materials are kind of staying stagnant, which is interesting. It's only up, $1.5 million, whereas their finished products have almost doubled. Now, on one hand, that makes a lot of sense. They have a lot more customers. They have to have a lot more inventory, right? There's more companies, more businesses buying from them. You have to increase your inventory. On the other hand, maybe this is, like I said, maybe this is because they have all these different products. And so let's say you have to have 100 of every product on standby for all your customers, regardless of how many customers you have. Well, if you only have 2 products, then you only need, 200 finished goods. However, if you have like 1,000 products, well then, if you need 100 or 200 of each one of them, so then you need, I forgot the exact numbers, but 200,000 in your inventory. So is that what's happening? Obviously, I'm taking pretty extreme examples here, but is that what's happening in terms of the finished goods? Or no, it's just because you have more customers? I'm not an expert in this kind of field, but my guess is it's a little bit of a mix of both, which might lend to the inefficiencies. Okay, so in terms of prepaid expenses, we can see the warrants receivable have been kind of knocked out, which I suppose is good. And in terms of prepaid advertising expenses, you can see that that's continuing, right? There's $5 million here. And is that exactly what we saw before? Is that going to continue, right? That's the question you would want to really keep an eye on. Like I said, it's not a big expense, but just something to keep an eye on, right? Does it get carried away, I suppose? In terms of their property, plant, equipment, right? This is what we talked about before. I just wanted to point out that they doubled, but of course, what I thought was interesting is construction progress has really gone up, and so you don't get that goodwill charge, right? Because you have to take the time to build it. You're not paying for it already being done. And so on one hand, I think that's really positive, right? It means they're taking the time to actually build and construct, and they won't be overcharged. I mean, unless you get overcharged for the service, but that will probably be much less than being overcharged for a whole company. In terms of assets acquired, right? Once again, we see this 20 million versus the 34 million. I don't like that. But like I said, sometimes that's the cost of doing business. Now, just looking at one of these acquisitions I thought was interesting, and just to hit the point home that we already spoke about, specialized machinery is 2.1 million. So as much as you're maybe overpaying for some of these things, building or land or whatever it might be, some of these things like specialized machinery, well, maybe it would take you a long time to order that machinery from a company, get it set up, get it going, get everything running, getting people to understand how that machinery works, training them, figuring out all the difficult issues. Well, instead, you could just buy the company with the workers, with it all set up, and Bob's your uncle, you've got it all done. And so that might be exactly what they're thinking, and then they don't have to wait, and then they can produce a lot more of those raw goods and keep things moving. And so that's why I'm not so bothered by them overpaying, but it's just something to keep in mind that sadly that's, I suppose part of doing business. Now, in terms of notes payable, you can see that I guess the biggest one is for this year, at the end of this year, $2.3 million. And it's very likely that that'll just be rolled over to the other years, but I think it's good to know that the other years don't have some large amount that, they might find trouble to keep rolling forward. Okay, not a big deal, just I suppose good news, or at least no bad news. So in terms of cash flow from operating activities, so we already kind of saw some of this, $24 million down, $44 million down from the investing activities, right? Those acquisitions and improvements, $76 million from the financing, like we said, talked about those warrants received. So they talk about here a net loss of $61.35 million. And a major part of that is income tax valuation allowance. Now, like I said, I'm not an expert at income tax, and so this a little bit confused me. I don't know if it's like a typo or something, but usually what income tax valuation allowance means, for anyone who's reading this, is usually you have a deferred tax asset. So let's say I had some losses in one year, and I'm going to be able to escape paying taxes in future years. I'll be able to move those losses forward. Okay, well, will I be able to take advantage of all of that? If I can, then great. If I can't, let's say I have a $40 million deferred tax asset, and I think I'm only going to be able to take advantage of $10 million of that because I'm not going to make so much money, well then I would remove from my income $30 million, right? Because I'm saying, I have this $40 million tax asset. Well, you don't really, so I'm going to remove $30 million because you really only have $10 million. And why that's interesting is because income tax valuation allowances are really up to kind of the managers, the CEOs, things like that. And so there's a lot of subjective opinion, because will you be able to use that deferred tax asset depends on whether you think you'll make money, not make money, make enough money to, pay enough taxes to use up your deferred tax asset, right? Those are the questions. And so he could legitimately say, oh, well, I didn't think we would use it all up. And you can play with your income and you can adjust it based off of, how much you think you'll use of your deferred tax asset. And so you can move things around. And one of the positive things, I suppose, if you're an investor is you can take a hit now and remove some income, increase your income tax valuation allowance, and then as time goes on, say, oh, wow, look at that, I'm really using all of my deferred tax asset, and so you'll get more income kind of written back into the records. And so, you can manipulate income tax valuation allowance pretty easily to give yourself income that you kind of said, I didn't think I was going to get that, but look at that, I am really getting it. And so you can boost your income in future years when maybe you would have missed a target. Well, now you can make a target. And so if you're an investor, maybe you like that because now you have a little more trust that you're going to keep hitting targets because there's kind of this buffer that the CEO can dip into. Now, is that what's going on? Did they lose that? Did they, like I said, I'd like to see this broken down a little bit more. As far as I understood, just from the basic level, the $61.35 million loss from their net income was because they paid taxes. They lost their deferred tax asset, but they paid taxes. And they only had $20 million loss, and we can see some of that broken up here. So I don't know exactly what's going on. Please comment below once again if you do. But on one hand, if I'm going to take what they're written as, true, and they're not making a mistake here, and or I'm making a mistake, so it pretty much gives them a little bit of leeway, quite a bit of leeway to adjust their income in future years. I don't personally like that it happens, right? I think every 10K we've seen where someone can kind of fudge some numbers to make it look better or worse. They take a little bit of hit, let's say in the goodwill or something, or whatever it might be, and that helps. They'll take it now all at once instead of, spacing that damage out over a long period of time. And so here's a similar thing. It just allows them to manipulate the numbers, which I don't like because I'd like to understand how the company's working. On the other hand, I do understand it gives them it allows them to smooth the trajectory of the company, because sometimes they don't make quite as much income. Sometimes they make a lot, sometimes they make a little. Not everything is just a straight line moving in the positive direction, and so this allows them to smooth it a little bit. So on one hand, I get it. On the other hand, I would like to really understand the company better. In terms of promotional expenses, you can see $5.53 million, and in terms of marketing expenses, $5.15 million. So now we're kind of seeing how the sales and marketing might be broken up here, that they're giving some of that sales and marketing, that $11 million or whatever it was, is promotional expenses. That's the way I'm looking at it. And I don't like promotional expenses as much personally. I'm not an expert in this business either. But if I'm giving a deal on a product, how many new people are getting that deal? On how many am I just giving to existing customers? My guess is I'm giving a lot more to existing customers than I am to new customers. Whereas marketing, you're more likely to hit people you didn't know just as much as people you did know. That's kind of my take on it. Obviously, that could be wrong, because maybe the promotional expenses help people switch from one product to another product, meaning, yes, I know Tattooed Chef, I was never gonna buy this, but I have 50% off, I'll try it out. And maybe you now increase your sales. So I'm not saying it's bad. That's just the way it works, and maybe they have no choice. Maybe Walmart requires to provide promotional expenses as part of the contract. I really don't know how these things work, but something to be aware of. In terms of the professional services, legal and accounting, $3.4 million. On one hand, I don't think that's going to change. On the other hand, they did have a lawsuit, if I recall, at one of their plants, and maybe that's resolved, and so maybe these legal fees will decrease. I don't know. I don't expect it to. In terms of their operating activities, right, so they spend $24.37 million, and you can see a major portion of that is from the $9 million increase in inventory. That makes sense, right? They're growing, like we talked about before. I'm not really bothered by that, even though I have some slight questions. In terms of their investing activities, they're talking about the fact that they can improve their efficiency and output from their current facility. So that $10 million that they used, that's to improve efficiency. So maybe that will reduce the cost of goods sold. That would be really good in my opinion. And then they acquired these 4 companies. Obviously, one of them is from Italy. I assume that's for raw goods, like we talked about. And the other one is a Mexican food facility, as far as I recall. And so they're increasing the products that they can provide. Like I said, I'm a little bit bothered by that personally. And here's why, right? This is from one of their 8Ks, so one of their slide decks that they have on their investor relations. You can look this up yourself if you like. And you can see how quickly the products are kind of multiplying. 2017 to 2018, 2 to, 6 or 7. Okay, that makes sense. They only have 2. They're going to increase their products. I don't have a problem with that. 2019, they had a few more products. Not so bad. But 2020, woo, that's a big jump. Now they have 38 products, 17 total new innovations. Now I'm not particularly familiar what total new innovations are. I can guess, but that's a big jump, right? There's too many products to even show. And then 2021, they've pretty much doubled that. 76 would be double. They've gone to 73. But they have doubled the total new innovations to 35. And so on one hand, that really bothers me. Why? Well, I guess if you've seen our video on Kraft Heinz, and maybe you should look at that just to get an idea of another food producer, very different type of food, but another food producer, one of the things that they had issues with was their similar issue, cost of goods, efficiency, And one of the things that the new CEO, they had a lot of turnover in CEOs trying to solve these problems, but he had felt that they had too many SKUs. They had too many different products. Some of the products weren't doing well. They were reducing their efficiency on the products that were doing well. You have to change machinery. There's downtime. There's, different people who understand different machines. And so, if one of them gets sick, whatever it might be. And so they had to reduce their SKUs. They had to reduce their product lineup to make themselves more efficient. And so what I'm seeing here is a very possible similar situation. They're ramping up very quickly and an enormous amount of food. Now, if all of the food is perfect and it's all flying off the shelves and they can make it more efficient, then great. I have no problem with that. In fact, keep going. Make more products. I don't have any issue with that. My guess is that they're not all great, right? And so do they cancel the not great ones? Okay, then that shows a lot of really strong leadership, and I would think that's positive, and this would not bother me at all. Comment down below if you know of that happening. I didn't see that, but I suppose I should search a little bit more. But that's another, if you want to call it red flag. How are they dealing with these products? Are they dealing with them well? Not everything's going to be a winner. I don't expect every single thing they make to be perfect and the best and 10 out of 10. But what do they do about the 4 out of 10s? Do they not have them? Do they get rid of them? What about the 6, the 7, right? Do they have a lot of 6 out of 10s versus 10 out of 10s? Well, why don't you cull those? Why don't you get rid of those? Is this because they just need to diversify because their clients are demanding more diversification in their products? That would also bother me. So really what you want to see is these products, first of all, do well, right? So they should all taste good, that's for sure. And if they don't, they should be cut. And even if they do taste good, can they improve the efficiency enough where the cost of goods is not going up, right? Who cares if you're selling way more product if you can't improve that efficiency? And that's one of the biggest questions that we're going to have. And I'll keep talking about that, of course. But it doesn't mean I wouldn't invest. It means I want to know what's happening. And it doesn't have to happen right away. I just want to know, why is it a problem and what's the solution? And I did see something about the CEO saying it's temporary. But why, right? That's what I really want to know. I want to get into the guts there, I suppose. Now, looking at another slide, they're talking about $63 billion of the frozen food category. Okay, that's pretty interesting. That's pretty amazing. Now, however, the frozen plant-based meat alternatives, $0.8 billion. So is that the same kind of market, right, that is so small in terms of this pie? Is that the same kind of market? I know it's not going to overlap exactly because this is vegan, and maybe vegans aren't looking for frozen plant-based meat alternatives, but I would assume they are. Is that how small kind of tattooed chef's slice of these different segments of pie that they've highlighted in red is? Right? Is that what we're looking at? That would be, in my opinion, very scary. I don't think that's what we're talking about personally, but that's something to keep in mind, that as much as we're looking at $63 billion of U.S. frozen food, the vegan section, as you can see, based off of this frozen plant-based meat alternative, might be very small. Now, in my opinion, like I said, my opinion, but I think that's going to grow. Veganism is seen as this healthy thing. I don't think it's just trendy. Frozen food is easier for people, especially students and people who are really busy. I get that. And especially if you're going to take frozen food, there's a part of me that thinks that I would prefer a vegan frozen entree than something that's meat. Why? Because I feel like the meat has going to have more chemicals, going to be more processed. It's not going to be as good as something fresh. And so even if I'm not vegan, I guess I could see myself buying something that's vegan. I don't know. I'm not exactly into frozen food. I can't remember the last time I've had frozen food. It's been a while. Unless I just thought, I was just keeping some bagels frozen or something like that. But it's been a while, so I'm sadly the worst person to really ask about the product. But that's what you're here for. So comment down below, I suppose, if you can add any to this pie, how big you think Tattooed Chef will be. In terms of their frozen fruits and vegetables, well, they really do vegetables as far as I know. Let us know if they do fruits as well. But, it's a portion here, not a big portion. Frozen entrees, obviously the biggest portion, obviously going to be their focus. Now, what made me a little bit nervous, what I want to know more about is why did they add salty snacks here? You can see everything else here is frozen. Now there's this different thing. First of all, salty snacks, not an entree, not a food, not a main kind of sort, but kind of like a snack is a little bit different than these types of things that they're offering. But more importantly, there's a lot more competition here, and a lot more competition that's also going to appeal to vegans just as well, as far as I'm concerned. Are they going to be healthy salty snacks? Is that their focus? Is that how they're going to get into the market? Now, I've heard that they're very tasty, the food they make, and so maybe this is a home run getting into salty snacks. Maybe this is just because they acquired that business, that Mexican food business that has salty snacks, and so they're just in it anyway. I'm not entirely sure, but that's something I would want to know about. It makes me nervous, like I said, about that expanding in terms of different product lineup. Are they expanding too quickly and too far? Now, in terms of some really amazing news, actually. So they were looking to hit 10,000 stores by 2021, and you can see how quickly they're growing, while they've already, by third quarter of 2021, already 12,000 stores. So that's really impressive. They're really expanding, they're really growing fast, and so I don't really want to understate this. That is huge. Now, in terms of their retail customers, 2020, that were some major customers, Walmart, Costco, and maybe some of this growth in terms of the stores is, these businesses are seeing, yes, Tattooed Chef is successful, and we're going to spread it to more of their stores. Well, in 2021, they're getting a lot more smaller stores, also making up a huge hit. Kroger is not a small store by any stretch of the imagination, but some of these, I suppose, are. I guess I've never heard of them. But they make a lot of sense, things like Whole Foods. That seems to be, I would think, a major target audience, for example, and some of the others as well, of course. And so I see that as really positive. I see it. This is a huge, huge positive, in fact. And in terms of this retailer case study, now, to be fair, it's only in plant-based frozen entrees, so it's a very small segment of that pie. But nevertheless, in that pie, you want to do well if you're Tattooed Chef, and they do. They have the first and second and 10th. Now, if you look at this, you can see that Amy's is kind of nipping at their heels, right? They have the 4th and 5th place and 9th place, right? So they're not doing quite as well, in my opinion, because Tattooed Chef has the first two. That, I think, is those are the best positions, because it means that you really have the best products, and both best products. And so that is huge for Tattooed Chef, in my opinion, but it doesn't mean that there's no one who's going to compete with them. Now, I tried to Google search, a comparison between Tattooed Chef and Amy's. I didn't find much. I did find someone discussing vegan, sources of food and things like that. What I found interesting is, sadly, it was only 12th in vegan frozen meals, but they say that the Buddha Bowl and Veggie Hemp Bowl from Tattooed Chef are clear customer favorites. And so, they don't have the first and second spots simply because they're cheaper than their competitors. They seem to have the first and second spot because customers really like them because they taste good. And that's really what you want in a product. You don't want it to just sell well because it's the cheapest one or the most expensive, whatever. You don't want to sell because of the price. People can, cut into that. You want to sell because people like your food. That's something that really brands you as a positive brand, and it's hard to compete with that necessarily. So that's a really huge positive for Tattooed Chef. And I can list a lot of them. They're growing in revenue. They're growing in stores. People love their food. And so those things are great. And these two things, these two foods specifically, amazing. Now the question is, are all their foods amazing, right? Are they diversifying way too quick and they're gonna, get sunk like we talked about in that Kraft Heinz, where they had to cut their SKUs. They had to cut their products to make themselves more efficient, and that was their major problem. Is that what's happening here? I don't know. Maybe not. I'm not sure. But I would love to see them cut some of the bad products, assuming they have bad products. But I don't think that's hard to believe that a company has a worst product that they could cut. But to me, the biggest question is that cost of goods sold that we pretty much mentioned from the very beginning. That is clearly, to me, the biggest issue that I want addressed. And I don't care if the CEO said it's temporary. Well, CEOs can say that all they want. In Kraft Heinz, they kept saying that their sales were going to do well and pick up, and they never did. Okay, so why is it temporary? How is this being mitigated? Is something else going to cause the cost of goods to go up? For example, the price of oil, right? That's going up. So these are the types of questions I want to know. If it was the cost of oil originally, if I see that number going up continually, I'm going to understand, the cost of goods are going to go even further up. Now, maybe I still want to own the company. I'm not saying that means don't own the company, but at least I'll know, I can buy more at this later date, or I'm going to expect to have bad numbers, and so I'm not going to be so surprised. Yeah, of course. These are the types of things I really like to understand. And so as far as I can see, I mentioned all the positives about the revenue growth, the stores, the products, the food tasting great. This is a great area, I think, as well, vegan, and also frozen, I think is pretty interesting. But like I said, the downsides to me are kind of clear, and I really want those answers. The cost of goods, why can't we get that profit? The income tax, is that going to be something that keeps going? Is that just because of the warrants? What's going on there exactly? I would like someone to just address that specifically so I know and I can put that to rest and not just have to have some assumptions about what's going on. And then, of course, we mentioned the product lineup. And like I said, I don't think every company's perfect. And, I did mention a few other things that concern me a little bit, like the dilution. Is that going to keep happening? I don't know. And so those are the things that I want to keep my eye on as we mentioned through this whole 10K. But those three things that I mentioned are the things I really want answered before I would really be willing to invest or tell someone else to invest. Now, I have not invested. I wouldn't say someone's wrong to invest in this company. I think there's a lot of potential. But there's a difference between Tesla and this company in terms of growth, right? A growth company, usually you're willing to forgive them not making a profit. Well, this company has been around for a long time, making all these foods. They have this amazing cushion of private labeling. And so they know what they're doing. And so if their cost of goods are going up, how are they going to reduce that? Why did that just happen? And why is that temporary? Whereas with Tesla, they're making a whole new product. They're doing a lot of research and development. You can kind of see how they're spending more money, and maybe they're not making the economies of scale yet. Well, this company kind of reversed their economies of scale in a way, right? Tattooed Chef, they went up 50% in terms of revenue, and yet their gross profit hardly went up. And so what that means is the cost of goods sold went up by a huge, let's say, ratio compared to the revenue. And so why did their cost of goods go up so much? I know I keep focusing on that point, but that's why I'm trying to hammer home that this is, to me, a really important question. So like I said, if anyone knows, please comment below. Yes, subscribe. And that tells me that what I'm doing is important and you want to know more. And of course, share. That would be just fine. I wouldn't mind, but I would also appreciate the comments. Let me know what you think, what I can improve, what I can focus, what I got wrong. I'm sure I got things wrong. Don't take anything I said as the ultimate truth. But what I think is important about these videos is going through step by step the things that jumped out at me that I had to think about, that I had to analyze in terms of their 10K, 10Q, and let me know what other companies you'd like me to address in the future. Thanks so much for watching.